Welcome to Celebrity Investing, your go-to source for insights, tips and updates on navigating the exciting landscape of personal and global finance. Please like, share and subscribe for more exclusive content. This is part 2 of Forward Contracts, a guide to mastering financial flexibility. Think of forward contracts like building your own computer. You choose the parts that make the most sense for what you need, rather than settling for a one-size-fits-all solution. This flexibility makes a forward contract an attractive option for many. Risks associated with forward contracts. When it comes to forward contracts, understanding the risks is just as important as grasping the basics. Although these instruments offer many opportunities, they also come with their own set of challenges. Let's walk through some of the key risks associated with forward contracts. Counterparty risk, the risk of counterparty default. Imagine trusting someone to fulfill their end of a bargain, and then they don't come through. That's the essence of counterparty risk. With forward contracts, you're entering an agreement with another party. If they fail to deliver on their promise, you're left in a tough spot. This risk is especially real when the other party doesn't have a strong financial background, or if market conditions suddenly change. Ways to manage counterparty risk. Credit checks. Before signing any agreement, it's wise to conduct a thorough credit check on the counterparty. This helps ensure they have the financial means to honor the contract. Third-party guarantors. Consider using third-party guarantors to provide an extra layer of security. This can protect you from potential defaults. Diversification. Don't put all your eggs in one basket. Spread out your contracts to minimize the impact if one party defaults. Market risk. Impact of market fluctuations. Ever noticed how the weather can change plans in a blink? Market fluctuations can do the same for forward contracts. Prices in the market vary for many reasons, from economic shifts to political events. These changes can affect the value of your forward contract, sometimes for the better, but often to your disadvantage. Ways to handle market risk. Hedging strategies. Just like wearing layers prepares you for unpredictable weather, using hedging strategies can safeguard your investments against sudden market changes. Consider using options or futures to counterbalance potential losses. Regular monitoring. Keeping a close watch on market trends helps you stay ahead. Regular updates allow you to make timely decisions and adjust your strategies as needed. Stop-loss orders. Setting a stop-loss order can act like a safety net, automatically limiting losses when prices hit a certain level. Understanding and managing these risks can help you navigate the world of forward contracts with confidence. So the next time you're considering a forward contract, think of these risks as the road signs on your map, guiding you through a potentially profitable but unpredictable journey. Forward contracts versus futures contracts. When it comes to planning for the future, businesses often rely on contracts to manage risks and lock in prices. Two popular instruments in this space are forward contracts and futures contracts. While they might look similar on the surface, there's a lot more happening under the hood. Let's break down the differences and see when you might want to use each. Key differences. Understanding forward and futures contracts starts with their differences. Here's a closer look. Customization. Forward contracts are like tailor-made suits. They're customized to fit the needs of the parties involved. This means you can design them to cater to specific terms and conditions. In contrast, futures contracts are more like ready-to-wear outfits. They are standardized and traded on exchanges, meaning everyone gets the same deal. Trading environment. Forward contracts are private and traded over-the-counter, OTC. This means they don't have to follow regulatory guidelines like futures do. Futures contracts, on the other hand, are traded on exchanges, which means they're subject to strict regulations to protect all parties involved. Risk and settlement. With forward contracts, the risk of default is higher because they're private agreements. There's no guarantee either party will fulfill their end. Futures contracts have a safety net called a clearinghouse, which ensures the integrity of every trade and limits the risk of default. Pricing and valuation. Pricing in forward contracts can vary widely because they are not publicly traded. Futures contracts have transparent pricing since they are traded on public exchanges. Flexibility. Forward contracts allow flexible settlement terms. You can decide how and when to settle. Futures contracts have predetermined settlement dates, which can sometimes feel like a one-size-fits-all hat, useful but not always perfect. When to use each contract type. Deciding when to use forward versus futures contracts can feel like choosing whether to take the freeway or a winding country road. Both will get you there, but the path you choose depends on your specific needs. Use forward contracts. When? Customization is key. You need terms that aren't available in standardized contracts. Privacy matters. You prefer to keep the details of your transactions private. Long-term commitments. Your business plans involve long-duration agreements without market interference. Use futures contracts. When? Standardization suffices. You're okay with standard terms and conditions. Transparency is crucial. You want to take advantage of transparent pricing and regulated environments. Need for liquidity. You require active trading markets to easily enter or exit positions. Navigating the choice between forward and futures contracts is about matching the right tool to your unique situation, like pairing the perfect key to a lock. Each contract type has its strengths, and understanding these can help you make an informed choice that aligns seamlessly with your business goals. Practical applications of forward contracts. Forward contracts might sound complex, but they are an essential tool for businesses navigating uncertain financial waters. Imagine you're steering a ship through a turbulent sea of market changes. Forward contracts serve as your compass, helping you maintain course by locking in prices for future deals. They are especially handy when big currency swings or unpredictable commodity prices threaten to throw you off track. Let's explore two major ways businesses use these contracts. Currency hedging, illustrating business use. Ever notice how the value of money changes when you travel abroad? For businesses trading internationally, these currency swings can make or break profits. That's where forward contracts come in. Imagine a tech company in the US buying parts from a Japanese supplier. The price is set in yen and they won't pay for 6 months. If the yen strengthens against the dollar, the cost could skyrocket. To dodge this risk, the tech company enters into a forward contract. They agree now on how much they'll pay in dollars when it's time to settle up. Why does this matter? Here are a few real-world scenarios. Budget certainty. A European retail chain can predict costs better by fixing exchange rates, avoiding surprises in their financial forecasts. Profit protection. A US food importer knows exactly how much their Spanish olives will cost, regardless of what the euro does. Peace of mind. Exporters from India selling software to the US can focus on business growth, not daily currency checks. By securing today's rate for tomorrow's transaction, businesses avoid riding the ups and downs of the currency roller coaster. Commodities trading, forward contracts in markets. Picture a farmer betting that this season's crop will yield plenty. But there's a twist. Commodity prices are as unpredictable as the weather. Forward contracts are like an umbrella, offering a sheltered spot in a storm. Let's break it down with another example. A coffee farmer in Brazil fears a global price drop after harvest. They strike a deal with a coffee distributor to sell their beans at a set price, delivered months later. This locks in their earnings and smooths out the financial bumps. Here's why these contracts are crucial. Market stability. Farmers and miners can plan for the future, knowing their income won't be dashed by sudden price drops. Supply assurance. A utility company locks in the cost of coal it needs, ensuring steady electricity prices for its customers. Risk reduction. Oil refineries can select when to buy supplies, dodging unexpected spikes that might erode profits. For businesses handling physical goods, securing a reliable price today ensures they won't be at the mercy of tomorrow's market whims. It's like wearing a seatbelt in a car, essential for safety and stability as they drive through the competitive landscape. By understanding and applying forward contracts wisely, businesses can make strategic adjustments that provide a smoother journey through economic uncertainties. Key takeaways on forward contracts. As we wrap up our exploration of forward contracts, it's clear they play a crucial role in financial markets. These tools are like promises between buyers and sellers, helping them plan for the future with more certainty. Understanding forward contracts can make a big difference in how we manage financial risk and take advantage of opportunities. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.